Good afternoon and welcome back to the Business Career College video series. In this series of videos, we're going to look at the taxation of investment income in Canada. We're going to do a basic set of videos initially here, and then there will be a more advanced set of videos. So this set of videos will be relevant for anybody doing pretty much any financial services exam. It'll be focused on students who are working towards, say, the LLQP or one of the mutual funds courses. So we have, in a sense, three different ways to tax investment income. We have a broad class of income, just ordinary income, and this is taxed the same way as employment income. So this is going to include things like interest, foreign dividend income, that is dividend income paid from a company that's not located in Canada. This would be rental income. This would be taxable policy gains on life insurance policies. This is just ordinary vanilla income. It has no particular tax treatment. If you have $1 of taxable income here, it's just taxed at your full marginal tax rate. So let's say we have a taxpayer who's at, just for the sake of argument, a 40% tax rate. That is, all of their other income has brought them to 40%. Now this person has, how about $1,000 of interest income. So that $1,000, now we'll assume this 40% is combined federal and provincial taxes. So that person would have less 40%, then they would have $600 that they would get to keep net of taxes. Or they've paid $400 of taxes. Okay, and that's easy enough. Nothing fancy there, exactly what we would expect. So then we could have dividend income. Now dividend income is quite complicated and we will deal with it in a number of later videos. For now, what we have to know about dividend income. First off, we're going to deal with dividend income paid by a publicly traded Canadian company. So for example, most of the banks would fit into this category. RBC or Scotiabank or whatever you happen to have. Big insurers like Power Corp or Sun would fit into this category. Our oil and gas companies, companies like Suncor, would fit into this category. So this is now a share of the after-tax profits of the corporation. So this corporation has made a little bit more money than what it needs. It's paid its taxes. Now it has some dollars left. It's going to distribute those dollars out to our shareholders. So how does this get distributed out? Well, let's say that we have, again, we'll keep this simple, $1,000 of dividend income. So I'm a shareholder in a corporation and I received a check for $1,000. So the first thing that happens here is this amount, it's treated a little differently here. Keep in mind, it was already taxed at the corporate level. So we generally try to avoid double taxation in Canada, but in this case, we have sort of a complex mechanism to take this into account. So you had $1,000 plus a 38% what we call dividend gross up. And that means you're actually going to pay tax as if you had $1,380. That's what's going to be taxable out of this dividend. So now I take that $1,380 and I apply that same 40% tax rate that we've been using, and I get $542.40, sorry, $542 even of tax payable. And then we have what's called the dividend tax credit. Now this is where this gets a little bit complicated, and I'll try and keep it as easy as I can here. So again, we're going to take that same grossed up amount, that $1,380, which is a completely notional figure. that only exists on your tax return. And now I take that $1,380 and I apply the dividend tax credit, which is a 25% federal credit. And in most provinces, it's around a 10% provincial credit for a combined total of 35%. Sorry, I apologize. I got a step ahead of myself there. A 15% federal credit, sorry about that. It's actually technically 15.02%, but 15% will suffice. Plus, let's say a 10% provincial credit for a combined 25%. So if you have $1,380 of dividend grossed up amount and a 25% credit, then you'll end up with a $345 tax credit. So basically, we can just follow this path now. You received $1,000. That was the amount of dividend. We figured out that there was $552 of tax to pay. And then against that tax, you're going to get a $345 credit. So in total, this taxpayer would get to keep $793, or they're paying $207 in taxes. Or we can see how this is going to work out, that out of $1,000, that means they paid about 20.7% of that amount received in taxes, or put another way, about half the rate on interest income. So here we can see it was a 40% rate, here about a 20% rate. Now, the third type of income that we'll look at very briefly are capital gains. And again, there will be much more to know about capital gains. In fact, this is one of the most robust and complex parts of our income tax system. The important thing to know here is that since 1972, if you bought a piece of property, so you buy a piece of property, and when I say property, that might mean tangible property like real estate, that might mean intangible property like shares in a business, let's say. So you buy a piece of property, we say the price you paid for it plus any costs of purchase gives you your adjusted cost base, ACB. And there are things you can do, as the name implies, to adjust your adjusted cost base. Capital improvements, for example, can change your adjusted cost base, as can reinvested dollars, for instance. And then when you dispose of that property, so when you have a disposition of that property, which can include all kinds of things. A sale would be the most obvious thing, but you could have a gift of a piece of property. You could donate that piece of property. You could trade that piece of property for another piece of property. You could die. You could leave Canada. These are all going to constitute dispositions of this property. So basically, the tax rules say you buy a piece of property for, how about $1,500? That's what we'll call your ACB. And then you own it for a number of years, and later on, when you get rid of it, when you dispose of it, it's worth $2,500. That might be the actual purchase price, or that might be the fair market value. In either case, then we end up with what we call proceeds of disposition. And the actual formula for a capital gain is we take your proceeds of disposition minus your ACB. So in this case, we have proceeds of $2,500. So you see the benefit here right away is that you had a tax deferral. Whatever number of years might have passed here, you weren't paying any tax on the gains that happened along the way. All your taxes are deferred until you actually dispose of that property. So now we have a $1,000 positive amount. That's what we call a capital gain. And then we would apply our capital gains inclusion rate. today, this capital gains inclusion rate is 50%. It has alternately been 50% and then for a while 75% and back down to 66 2/3%, and it's been at 50% now for about 14 years. So this person ends up with a $500, what we call taxable capital gain. Oops. Taxable capital gain of $500. So we can see already how this is going to be an effective method for saving some taxes, because you're not paying tax on the full gain. We have $500 here that was tax-free in a sense. And now on that $500, we apply again that same tax rate. We'll continue to use the 40% tax rate that we've been using all the way through here. That's going to give me $200 in tax payable. So again, we see that we get to keep $800 tax-free. We pay $200 in taxes. $200 in taxes out of $1,000 of capital gains means in this case, this taxpayer paid about 20%, in fact exactly 20%, of the amount they received as taxes. So you may have to do any of these calculations for the mutual funds or LLQP exam. You may or may not have to memorize the gross up and credit figures, and if you do, the figures you would want to know here are the 38% and the 15%. Do not memorize provincial credits. This is different in every province. And certainly, no matter which exam you're writing, you'll have to memorize the 50% capital gains inclusion rate. That's a very frequent figure to see on exam questions that deal with any sort of taxation. So absolutely take the 50% away with you. Maybe, maybe not as far as memorizing the 38% and 15%. And of course, you'd never memorize the tax rates. You'll be given these as you need them on exams. I hope you find that helpful. Please enjoy your continued studies. Thank you.